Hi, I'm going to give you a little more in-depth discussion of the audit risk model based on input from students who are having trouble understanding this concept, as well as materiality and evidence. First of all, the audit risk model is used in order that the auditor can determine whether he has sufficient evidence. I'm going to explain each one of the audit risk components and then detail how it deals with evidence. First of all, the audit risk model says that AR, audit risk, equals IR, the inherent risk, times CR, the control risk, times DR, which is the detection risk. And DR is the only one of these components that the auditor does not set. So I'm going to rewrite the equation to show that the audit risk divided by the multiple of the inherent times the control risk equals detection risk. And I have the three items that are isolated that the auditor sets on one side and DR, which is the result, on the other. Audit risk is the risk that the auditor is willing to accept that he will issue a clean opinion on the financial statements when in fact they actually do have a material misstatement. And because this risk should not be high, it's usually set between 1 and 10%. Basically, if he's willing to accept a high risk that there will be material misstatement, he's not very professional as far as conducting this audit. The audit risk is set by the auditor. The lower the audit risk is going to be set, the more evidence that will be required to be collected in this audit. The IR is the inherent risk, and that's the risk that a transaction or account that I am trying to gather evidence for will contain a material misstatement, not even considering whether there are any internal controls in place to prevent or detect misstatements. So I look at the account, I look at the transaction. Obviously, the more complex the event, the more the inherent risk will be increased. For instance, trying to audit derivatives is a lot more complex than trying to audit the supplies account. So the inherent risk for derivatives would be set at a high level. The accounts also have to take in consideration the fact that people might want to commit fraud, like cash is much more susceptible to having a high inherent risk than, say, accounts payable. Likewise, inventory, because of the valuation issues, is more inherently risky than accounts payable as well. Individuals usually do not want to steal somebody's accounts payable. However, that doesn't mean that accounts payable doesn't have any inherent risk. Often, companies don't want to include all their liabilities in the financial statements, so there is some inherent risk associated with account payable as well. With inherent risk, the higher that you set the risk, the more evidence you will need. So if you remember audit risk, the lower, the higher the evidence. So audit risk is inversely related to evidence, where inherent risk is directly related to evidence. The higher the IR, the higher the amount of evidence. Control risk is the risk that you are going to have controls in place that won't prevent or detect material misstatements in the financial statements. The auditor is responsible for understanding the controls put in place by a company called their internal control system. He has to issue on the audit report his statement regarding the internal controls and his understanding of this company's controls. And he also uses that to determine the nature, time, and extent of the testing to be done. Nature dealing with how am I going to test, timing, when am I going to test, and scope dealing with how much am I going to test. If I am going to rely on the internal controls, I am going to set the CR low, at a low level. If I'm not going to rely on the internal controls to prevent or detect mistakes, I'll set it at a high level. In any case, you have to understand the controls of the company and document that in your financial statements. the higher the CR, the more evidence you will have to get. So IR and CR are both directly related to evidence. As they go up, evidence goes up as well. Detection risk is the risk or probability that there is a material misstatement in the financial statements that goes undetected, and the detection risk is the only one not set by the auditor. The lower the DR, the more evidence you will have to gather. If you think of DR as a probability versus a risk, the probability of finding that material misstatement, you'll understand that the lower the probability, the higher the amount of evidence I'm going to have to gather. I can always look at the detection risk and determine based on evidence gathering techniques that I might have to change it and gather more evidence. So as I'm conducting the audit, just because I set these levels at the beginning of audit doesn't mean that they're going to be constant throughout the audit. They are susceptible to reevaluation depending upon what happens as you conduct the audit. Another thing I have to evaluate is the materiality thresholds for the audit, and basically I'm considering what amount is going to be big enough. And auditors sometimes set the audit risk levels for the entire audit, or sometimes they go through and set materiality threshold levels for the balance sheet and then for the income statement. And then I will look at the accounts that are affected by the error or misstatement that I find, and if they only affect one financial statement, I will use whatever the threshold is for that sole financial statement, whereas like with most transactions, they usually affect a balance sheet and an income statement account, then I'm going to use the lower of the threshold set by the income statement or the balance sheet. And during the conduct of the audit, if I find a lot of misstatements that are either right below the materiality threshold or I find a lot that are above that threshold, I might have to reassess the materiality levels that I have set at the beginning of the audit. In addition, anything that falls below the threshold, while it might not be considered material by itself, I keep what is called an aggregate of all of the mistakes that fall below that threshold. Is called aggregate materiality levels, so that I can see if when I add all these quote minor or immaterial errors and misstatements together, do they actually then become material. The lower the materiality threshold, the more evidence you're going to have to gather, because the lower the error, the more likely it will be to be considered material. And then to gather evidence in the audit, there are different types of evidence you can use. Some is internally generated within the company, and that is less reliable than external evidence, which either comes from a third party or is gathered by the auditor himself. So the external is more reliable than the internal. Methods of gathering evidence include inquiry. That just means asking of management, how do you do this, or are there any things that we should be looking at? Because it's internal and it's management giving you that evidence, it's not as reliable as some of the others. Scanning means just looking at documents, trying to find things that look abnormal, like a credit balance and accounts receivable, or maybe scanning minutes of the board of directors to look for any dividends that were declared during the period. Recomputing means recalculating things like the interest accrual for the notes receivable at year end, or recalculating the amount shown as liabilities for payroll. Reprocessing means that you're going to go through and actually watch, or send through the accounting system either a real or a fictitious transaction to see how it passes through the accounting system and what the end result will be. So you actually reprocess some type of transaction. Vouching and tracing deal with going either from the general ledger to the original document, or from the original document back to the general ledger. If I'm trying to look for completeness, I am not going to go from the general ledger. I'm going to go from the source documents. If I'm trying to look for existence, I'm going to go from the general ledger and look for a source document that proves that this asset or balance sheet item really exists. Footing means adding columns up and down. So if I have a column of numbers with a total, you shouldn't just automatically assume that it actually adds up. Footing means you re-add it. Cross-footing means that I am going to add a cross. So I have several columns that equal a total. You have to add all those column totals, first footing them and then cross-footing them to make sure that they actually balance. And then observation is just to watch. For instance, you want to see what happens during a payroll reporting period if people are not there to pick up their paychecks. So you just watch and observe a normal pay period as the checks are distributed and see what happens should somebody not be there. I hope this has helped you with understanding some of the concepts. If you have any questions, please don't hesitate to ask in the Blackboard discussion area. Thanks.